The stock market is about to go crazy. US CPI numbers released mid-November show that inflation remained flat for the past 2 months, coming in at 3.2%, close to the Federal Reserve's target of 2%. As a result, the S&P 500 saw an immediate rally when investors flocked in to grab a slice of the action. Lower US CPI numbers have given investors increased confidence that there will be interest rate decreases in the near future. With lower interest rates, companies have to work less hard to make the same amount of profit, which increases the likelihood that these companies will be more valuable in the future. But that isn't all. New data has just come out from the UK, and there is a sharp fall in inflation here too. The numbers for the UK came in at 4.6% 12 months to October. This is the lowest figure for nearly 2 whole years. The main reason for this stark drop in inflation was mostly attributed to the falling price of gas. The price of gas is almost a third less than the price it was this time last year. As a result of this inflation data, the UK stock market has also seen a boom, with the FTSE 250 rising nearly 5% within a single day, and the FTSE 100 rising over 1% as a direct response to the announcement of these figures. So analysts are expecting interest rates to be dropping very soon, and this could possibly be the start of a new bull market as investors feed off the optimism of all these numbers coming in lower than expected. However, there are still a number of concerns that could potentially overshadow all this good news. The government's inflation target is based on an average over 3 months, not just 1 month like we've seen now. So technically the UK isn't really there yet. Falling domestic energy prices are a key reason for inflation going away for now. Yet more people will actually be paying more for their gas and electricity this winter than they did a year ago. The key factor to this is the reduction in financial support from the government. Over the course of 6 months last winter, almost everyone received £400 off their energy bill, funded by the government, which will not be repeated this year. So while the price of energy is lower for the next few months, energy bills could be higher. While the overall rate of inflation is easing, price growth continues to increase. Remember, a fall in inflation rate does not mean that prices are coming down. It just means that they are rising less quickly. So last month, the biggest contributors to inflation was alcohol and tobacco at 11.1%, food and drink at 10.1%, communication at 8.1%, and health at 8%. So if you were lucky enough to have stayed investing during these recent market downturns, then your portfolio would probably be thanking you right now and a lot more in the near future. High bond yields and greater than normal savings rates on high street bank accounts have really pushed the public to stay with cash, but as we know, cash is a depreciating asset. This high interest rate environment has made it seem like the stock market was the worst place to store your money, but let me remind you of the historical statistics. In the past 5, 10 and 20 years, cash savings have failed to keep up with price rises, and so depositors could be worse off with cash. Over very long periods, during which inflation and interest rates have gone through both highs and lows, cash has somewhat retained its spending power, but not by much at all. By contrast, however, the stock market is very different. It has delivered inflation-beating returns over all the periods shown in this graph. In the 5 years prior to 2022, stocks greatly outweighed the return on government bonds and cash savings. The same is true from these graphs from 10 years before 2022, 20 years before, and also 50 years before. We have to go back over 50 years before 2022 to start seeing cash provide a positive return over inflation. Banks are generally not incentivized to pass on the interest to their customers, but with a rising number of fintech companies offering high rate of interest on easy access savings accounts and the increasing popularity for money market funds, it has become more tempting than ever to stick with just cash. However, the stock market will always have a premium over such equities. As the finance world generally goes, the higher the risk that you're going to put your money under, the greater the reward in the future. And in the stock market, you pay a great premium for this such risk. When times are tough, the stock market is the first to get battered, and many investors don't have the knack for it, or typically they don't even have the time for it. That's why, as a long-term investor, I will always choose the stock market over cash for the long term. As the age-old saying goes, time in the market is way better than trying to time the market. If you're holding on to cash, what you're saying is that you can time the market better than everyone else. In fact, today I received a comment saying just that, how I wasted a year in the stock market when I could have put that into an easy access savings account. However, as an investor who stayed invested during this time period, let me show you how my main portfolios look just 1 week ago compared to today when the market has reacted to such good news. Remember, when investing, your capital is always at risk. The stock market will always be volatile. So the numbers I'm showing you today could well and truly go down 20% the next day, and I could look like a fool right after showing you this. So this is my Trading 212 portfolio. I released one very recently, but it's already rendered out of date because of the huge increase we've seen over the past few hours. So what I want to show you is the monthly change. You can see on the 26th of October, which was around 2 weeks ago, I was down by 7%. So that's a £901 loss. That is down 7%, something that a lot of people cannot stomach. However, just a few weeks later, I am up by 3%. That is a difference of 10% in a matter of weeks. That is something that you cannot get with a bank account, bonds, saving accounts, or anything like that. Granted, yes, there is a lot of volatility, but investors will always look towards the stock market for long-term growth, long-term investments, and just generally building that wealth. It is especially during these downturns when you can buy your favorite stocks or the ones that you're watching for an immensely good price. This video has nothing to do with individual stock picking or anything like that. It's just saying that historically speaking and based on data, the stock market is always a forward-looking and overall speaking, all the companies combined, not necessarily just looking at one or two companies, it does go up as gross domestic product of every country increases. Hopefully you see where I am going with this anyway. Most of my portfolio is based on ETFs such as the S&P 500 and the FTSE 250, and as a result I get exposure to most of the market speaking in terms of the Western world. Therefore, when these indexes go up, my portfolio goes up as well. But generally speaking, even if you don't have these indexes, you are likely to have seen a huge increase in your portfolio based on this inflation data. Now, here is my free trade ISA. And again, I want to show you what's been happening over the past month. You can see that at the end of October, my portfolio was only worth £48,599. Today, the same portfolio is worth over £53,000. This is an increase of over £2,000 within a matter of weeks. The same amount put into instant access savings account would not even yield anywhere near that in that short amount of time. You can see that overall I am still down in these companies. However, what I want to show you is the power of the stock market, and when investors are optimistic, that power really does get realized. And compared to cash in the medium and long term, stocks have historically always beaten out the returns of cash with or without factoring in inflation. So let me know how your portfolio has reacted in response to all this news. So checking the stock market the next day, you can see that the indices or indexes, however you want to call it, have dropped a little bit. The purpose of this video is not to say that the stock market is definitely better than any other form of storing your money, because in the short term, it really isn't. What I'm trying to say is that if you want to build long-term wealth, there really isn't better of an option than the stock market. If you would like to get started on your investing journey, check out the links in the description down below for my most recommended investment providers. And make sure to check out some of my other videos, and I will see you in the next video.